Good afternoon and welcome to today's webinar, Biden's Tax Plan, California Propositions and Your Estate, presented by Noel Minto, Principal and Founder of NM Law. Today's webinar will provide analysis and strategies to mitigate the effects of a potential change in the current federal tax plan and state-level changes for individuals and corporations. Ms. Minto's analysis and mitigation strategies will cover key findings of Biden's tax plan and its potential impact on individuals and corporations, California Prop 15 change in commercial property tax, California Prop 19 change in property tax rules, California Prop 21 local government rent control, California Prop 22 app-based drivers as contractors, not employees, and California Prop 24, which expands consumer privacy. With that, I have the pleasure of introducing Noel Minto. Since 2003, Ms. Minto has been an estate and business transactional attorney based in Orange County, California. Her practice represents high net worth individuals and privately held business entities based throughout the United States and abroad. Ms. Minto has assisted clients in crafting comprehensive estate plans and maintaining business structures to address each family's specific needs, including everything from revocable trusts to formation of charitable entities, including public charities and private foundations, to a myriad of estate planning tools, including qualified personal residence trusts and land trusts. She also assists clients with the formation and maintenance of family limited partnerships, buy-sell agreements, intentionally defective grantor trusts, and many other tax savings and asset preservation vehicles. Once an estate plan is implemented, Ms. Minto and her team continue to support clients with many ongoing compliance and coordinating with each client's circle of advisors. When needed, NM Law facilitates annual family meetings, corporate maintenance, and assisting with transitional time periods brought on by retirement, incapacity, liquidating events, and ultimately administration upon death of a settlor. As a seasoned estate and succession planning practitioner, Ms. Minto provides guidance and comfort to trustees and beneficiaries of the descendants after their passing, and throughout the trust administration process, as well as assistance in transitioning family business interests. Ms. Minto has a long-standing relationship with various national bank trust divisions who bring her in to provide estate planning services for their private wealth clients and work alongside their skilled teams to ensure the clients have carte blanche, white glove service in all of the legal services being delivered to those clients who are typically generational wealth clients or successful business owners. Ms. Minto was selected as Southern California Rising Star by Super Lawyers in 2008 and 2010. She speaks Italian, Spanish, and French. She sits on 2 charitable boards in Orange County and is the past chair of the business and corporate section of the Orange County Bar Association. Her firm was incorporated in 2006 and is dedicated exclusively to the fields of trusts and estates and business planning. With over $1 billion of assets planned for and protected, Ms. Minto and her team have positively represented hundreds of families and generations. And with that, I'm proud to introduce Noel Minto.
Thanks for the introduction, Jody. And to everybody who's joined us, good afternoon, and thanks for joining us for this, what will be a brief webinar designed to assist those who are focusing on estate planning and business operations, as well as succession planning. And of course, to all of you advisors who are responsible to address all of these very impactful changes to our system. There were many propositions on the California ballot, as you know, but I'll be discussing only the most relevant. And we'll be doing so in such a cursory fashion because we've got so many to get through. Now, because our overview is going to cover a lot of territory, and I want to be respectful of everybody's time, We'll encourage each of you to feel free to reach out to our firm for any questions, or perhaps to any of your other advisors for further consideration and analysis as to how these changes are going to impact your family moving forward. I have no doubt that at least one of these new laws will directly impact each and every one of us. And I hate to say it, but probably not in a good way. Now, I am going to get through a couple of California propositions, mostly related to real property tax to start. So feel free to put questions in the chat, and then we'll take a break to sort of address any specific questions related to those propositions. And then we'll continue on to the rest of the program. And my goal is to get you out of here before the hour and leave plenty of time for questions. Now, I've also noticed a couple of you have been, it seems like, kicked out and had to join in again. So go ahead and put in the chat if you're having some technical problems, and we'll try and get you in here. Okay, so California propositions. We've got my contact information, including my email, on the right side of the slide. Feel free to take it down, or I'll put it in the chat towards the end in case you want to email a more personal question as to how these changes might affect your estate. What we're going to cover today is Prop 15, which was the split roll proposition, California Proposition 19, which I think is the most disruptive, Prop 21 regarding rent control, Prop 22 regarding essentially the independent contractor status of drivers, and Proposition 24, which expands an already expansive consumer privacy law in California. And then last, but of course not least, we'll be talking about how we're anticipating Biden's tax plan, or at least proposals for tax adjustments, are likely to impact individuals and businesses alike. Okay, California Proposition 15, which was the prop that proposed we do an annual assessment of commercial properties above a certain size. That did not pass, and it will not be changing. A no vote means essentially that we will not institute a split roll process by which we would annually assess commercial properties. We will leave it to be assessed at a base year, and it will still fall under Proposition 13, which means it will be adjusted annually as long as you own the same property, and it does not change hands, and it will be capped at that 2% per annum that was instituted by Prop 13 way back in 1976. As you can see, California is pretty evenly divided on this, and I bring that up because these propositions that eat away at Prop 13 have been repeatedly on the ballot. So just because it didn't pass this year, it may pass next, or perhaps 4 years from now. This gives you a clue as to how many times we've tried to really whittle away some of the protections that Prop 13 instituted. You can see the legislative attempts to close the property transfer loophole happened in 2014, 15, 18, and again this year. This year they were successful with Prop 19. And then you've got some other examples of administrative or legislative or case law that tried to eat away at it over the years. Now, Prop 13, as I mentioned, was instituted in 1976, but it's been built on since then. And each of these have sort of created the Proposition 13 protections that we have really come to know and love in California. And I will say Prop 13 is really impactful on some of my clients. California, in particular Orange County, has a lot of real estate wealth. And I know myriad of families that without Prop 13 probably would not have a livelihood because they've had parent-to-child transfers in year over year that have allowed them to have expansive cash flow from these properties that were built or acquired back in the 50s or 60s. Now, in 1978, Proposition 8 allowed for the reassessment of properties in a downward market. Now, any of us who might recall 2008 and who had real property at the time are probably familiar with that. Now, what that would do would be allow you to roll back the base value upon which your real property tax is assessed, and then it could be capped at 2% per annum from that lower market. That was it's a very simple form, and it was really during really bad times. It's something that people take advantage of. Now, in 1986, in my opinion, the most significant amendment to Prop 13 took place, and that was Prop 58. That really is one of the hallmarks of what we think of when we hear Prop 13. That essentially said that you have an unlimited cap on your principal residence passing from parent to child without a reassessment of property tax, in addition to $1 million of assessed value. So what that means is if grandma and grandpa bought a house on Balboa Island, for $50,000 way back in 1950, and it might be worth 6 million or 8 million today, that essentially that entire value could pass on, if it was their principal residence, to their children without any increase in property tax. Okay, and then in addition to that, the $1 million was assessed value, and it could be multiple properties. It did not have to be their principal residence. And it's really important to understand the distinction, because I have clients who might have $60 million of real property in today's market value, but because they were purchased or acquired so long ago, they're able to transfer perhaps half of that wealth under the $1 million of assessment. And that's because the 2% cap didn't allow the increase in the real property tax assessment. So a really powerful tool, or at least it was until Prop 19, and we'll get into that in a second. Then Prop 60 essentially allowed you to transfer your property tax rate to another property, but it was only within the same county, and it was only if you were downsizing, essentially. So pretty restrictive. And I want to get into that because I think there was a lot of propaganda with this proposition, Prop 19. People saw only this 55 and over allowance to transfer your property tax base. And frankly, I don't think they read the fine print and understood that they had a lot of negative impacts that they were adopting in Prop 19 as well. And then Prop 90 essentially allowed this to expand to different counties if they gave reciprocity. And 193 in 1996, this essentially just said, this parent-child exclusion from reassessment will include grandchildren if the parent predeceased. In other words, the grandchild could inherit in the stead of the parent, and they would not have to suffer from an increased property tax rate. All right, so obviously Prop 13 matters, and it matters more significantly to some families than to others. But it matters because I have many, many clients, and I'm sure you do too, that essentially cannot pass on. It might be a vacation home, it might be a beautiful home on the beach in Laguna, or a very valuable cash flow commercial income property. And frankly, if there was a reassessment up to the current assessed value, their children or other relatives could just simply not afford to keep that property with having to pay essentially market rate property tax. So, the other sort of big piece I alluded to earlier is we've got a lot of real estate wealth in Orange County, and I have many, many clients who live off of the cash flow from a well-acquired property, and it might go down to multiple generations. And multiple people within a generation might be surviving off of or be supported in some way from one or two buildings. So this could essentially pass on generation after generation. There was no cap in as long as it went from parent to child, and there wasn't a sale or some other type of transaction. You could essentially keep passing on and keep that property tax base from 4 or 5 generations prior. Of course, we've only had it for about 50 years, so we've only seen it pass through about 3 generations. Okay, so typically the advice was not to put a property into an LLC or another entity because we were concerned about property tax preservation. Now, this was not always the case, but it was a consideration that needed to be made. In that example where we've got a beachfront property that perhaps is paying property tax based on a $500,000 assessed value, and it's now worth $9 million, we need to think long and hard before we jeopardize that parent-child exclusion. And a lot of times, if you have a litigation attorney advising you or somebody who only has a piece of the puzzle, they might not understand that transfers into an LLC had to be done in a very particular way where parent and child are co-original owners so as not to reassess the entire property upon the death of the parent. So it could be done, it just needed to be done in a very specific way. The other thing that it did is it made sure that, we need to make sure when we're doing planning that any child who actually has the intent to keep the property is specifically gifted that property with equalizers to the other children. And we do that because there is no such thing as a sibling to sibling transfer exemption. So if there needs to be a sale from the trust, or if there needs to be some sort of transaction to make the children take equal value, if you haven't dealt with it in a very specific way in your trust, you're going to have a problem with this triggering of reassessment. And likewise, this is going to be the case now, and it's been the case for some time, that with Prop 13, if you have other people in the family that you want to pass your property to, you can insert the children in the plan in some way to continue that parent-child exclusion from reassessment. So they could just get a life estate or some lifetime income benefit, and we might be able to preserve the parent-child exemption. And just like I mentioned with the LLC, we typically did not place a property into an irrevocable trust if the property tax reassessment was going to be that substantial, where it was a clear negative. Okay, so now we get to the fun stuff. This is our new reality, Prop 19. And we don't have really much of a runway here because this is obviously a past. And just like the other, proposition, Prop 15, it passed pretty much down the middle. Now, here's what people saw. Oh, I'm 55 or older, or I'm disabled. I get to keep my property tax savings if I move to a new property anywhere in California. That sounds good to me. I honestly don't think people understood what they were voting for when they saw not only all of the negatives that came along with Prop 19, but also how the money was earmarked. So essentially you can see 51 to 48, almost 49%, it was pretty much split down the middle. This is a very detailed proposition. If you want to read the text of the law in terms of how the money was earmarked and where it's going, it's essentially going to firefighting and really is only earmarked for that. It's going to be a huge increase in revenue over, I'd say, the next 10 years for California, and it will be spent in a very specific way. It is a California constitutional amendment, and it eats away at several of the progeny of Prop 13, as I mentioned. So essentially, now what we've got here is we've got a little teeny tiny exclusion for Prop 13 for passing from one generation to the next. It's only going to pass between parent and child, and it's only if the parent and the child are using it as their principal residence, right? So that's going to really whittle away at what we could have applied to it before. Now, you need to already have reported this as your primary residence on your PCOR. That's your preliminary change of ownership report, which is filed with every deed in any county in California. And you've got to check that box to say it is your principal residence, or you're not going to be able to transport that as a 55-year-old to another home. And you're not going to be able to pass it on to a child to whom you want to leave that principal residence as well. All right, so the recap is essentially we've got a reduction and almost a complete elimination, I would say, of the parent-child exclusion from reassessment. It only applies to the primary residence of both parent and child. And then the example I gave you of that beautiful home down on Balboa, unfortunately, it's also capped in terms of dollars. So it used to be an unlimited exclusion. You want to pass a $30 million house to your child and pass on that same $500,000 property tax base. Guess what? That's over. Now you get the current assessed value, essentially $1 million of savings. So if you've got that scenario, you've got a 500,000 base year, and then you've got a $25 million property, you can only do 1.5 million of assessed value that you pass on. leaving the other 23.5 million to be reassessed to market value. So under Prop 13, that's 1%, and do the math, it's a pretty hefty payment there. Now we've got no parent-child exclusion from reassessment on commercial property or vacation homes. So we've got essentially next generation will not be so lucky as to carry on the cash flow expectations that their parents have had. Now, of course, the upside, and this is the side that I think American voters really supported, was that you could have statewide transfer of your property tax base if you're disabled or 55, and you can keep transferring it. And you are not bound to downgrade your house, right? So if you want to upgrade, there's a formula by which they'll sort of add a little bit of assessed value to any sort of increased property, but you will keep the same rate on sort of dollar for dollar. All right, so before we go on to Prop 21, does anybody, I think I've got a question here. And I'm guessing it is a private question, is sort of asking about a special needs trust. And yes, to answer the question, generally the disability definition in Prop 19, it accounts for veterans, disabled veterans, and then people with special needs. So I actually later in the slides do have an example of how we can pass on and earmark a property for a special needs child, because that transferability allows you to sort of move houses and keep that same property tax preservation that you've had for years. Okay, any other questions? Oh, Prop 19, when does it go into effect? That's a really good question. February of next year. So we're going to be talking about a couple other propositions, and most of them give you a couple years of runway adjustments and so on. And so I was making a joke with a colleague earlier. I'm really afraid for the safety of the elder generation between now and February, because this is an absolutely huge loss for some families. It's scary stuff. It's coming in, just what, 3.5 months from now. And and then the follow-up question to that was, would you recommend the property be gifted to the next generation now to avoid this happening? That is a great question. And we'll sort of tie that together when we look at the Biden proposals, because keep in mind, so many people keep these properties, and they keep them for two reasons. So one is what we're talking about with property tax, right? Because we've got this just amazing benefit for a property that's appreciated so drastically. But the other really important reason is if the parents died with that property in their name, they got to step up in basis, meaning if they bought it for $50,000 and it's now worth $5 million, essentially you get an appraisal as of the date of death, and you could sell it the very next day without a penny of capital gains. And so, if properties are gifted, you're not going to have a gain. You're just going to have that very low basis that's going to continue on to another relative. But yeah, it's something that should be considered strategically. I think everybody in our industry needs to probably have a cup of coffee, as I expect that everybody's going to be extremely busy, even if it's just fielding questions over the next couple months. And for people who are ready to take action, I think there's going to be a lot of clients demanding that. Okay, moving on to California Proposition 21. So this didn't pass. I bring this up only to say that, again, representing a lot of families that have real estate wealth, and some families with multifamily dwellings as their main investment. Essentially, we are safe from rent control for right now. That would have been another drain on cash flow and another sort of just unknown variable that might have scared people away, in addition to Proposition 19, in addition to the loss of the stepped up basis, and whatever else might be sort of facing us under a Biden administration. But at least with respect to California expansion of rent control sort of being governed at the state level, we're safe for the time being. And if you look at the ratio, it looks like this is, most Californians do not sort of support having broad sweeping rent control. Okay, Prop 22. Now, I know I don't represent Uber, and probably most of you out there are not large stakeholders of Lyft or Uber, but I bring this up because, as all of you advisors are well aware, employers and California businesses have been just really under scrutiny, pressure for many years now in the recent past. And I'm not an employment lawyer, but I give general advice to business owners. And my general advice on the employment relationship has been, it's an employee, period. I'm not going through the analysis, because the Dynamex case and AB5, essentially in California, you had to be purple, born on a Tuesday at 2:55 a.m. and have walked into the building backwards in order to qualify as an independent contractor, right? It was that narrow of a group. And, so the safe advice, because the penalties were so severe, was just to say, classify them as an employee. And so this was really the first little foothold that we've had, the first little hope that business owners might have, especially ones that have sort of a need for flex staff and so on, that we might have sort of a shifting. California has overreached, and maybe this is the voters saying, we want the flexibility. We want the ability as the workers to decide whether we're treated as an employee or if we want the freedoms of a contractor. And so this, again, is, it did pass, and it passed essentially, with flying colors. So it looks like this might be a notice to the legislators. Okay, Prop 24. Again, this is for people who are advising businesses and business owners. I'd say if you have kids who are in law school, you might want to advise them to be consumer protection attorneys, to be privacy attorneys, because I think that this is sort of the wave of the future. I think just like HIPAA was a burden to sort of administer and figure out and change systems in the medical world, I think this is going to apply to any business that essentially for any reason has to collect data, not just social media companies. All right, so what is this proposition? It essentially expanded on a just freshly passed law, which was a consumer data privacy law, and it's just expanding on it, and it's requiring businesses to sort of up the ante on their requirements and what they're obligated to do regulatory wise. And then we've formed a new state agency, yet another one, and the state's Department of Justice are both going to oversee and enforce these state consumer privacy laws. So California Privacy Rights Act, it's known as the CPRA. It's literally the only act of its kind in the 50 states. It's very cutting edge. California is much more akin to Europe in this regard. And it's surprisingly, just past 2 years ago, the California Consumer Privacy Act in 2018 was passed. And this is, again, just widening its sort of impact. But this one is a little more gracious. They're giving us a couple of years to get our acts together as businesses or people advising businesses that collect data. And then you've got a 6-month grace period before they start the heavy enforcement. It gives Californians the right to know what data is being collected. And it also prohibits businesses from selling data related to race, religion, and so on. Now, biometrics is interesting. That's sort of, I don't know if that goes beyond medical. I don't know how they're collecting that data. It's probably some of those health apps and so on. All right, now here's something interesting. There are extra penalties if the consumer is under 16. Well, in my opinion, the people giving away their data freely, right, are mostly under 16. And so I think this is going to pose a really great challenge for those businesses that might be extracting data, whether directly or indirectly. And as you'll see on the next slide, what's interesting is we're sort of expanding our responsibility level as partners of those businesses. So this is why I say encourage your kids maybe to head into this area of law, because I think it's really cutting edge and likely to really require businesses to not only have an employment lawyer, not only have a litigation attorney at their disposal, but I think they're going to have a privacy and security attorney at their disposal and in their Rolodex. As I mentioned, so European Union, pretty much since the advent of the internet or its wide adoption in Europe, they have essentially instituted what's called General Data Protection Regulation. And it is a tough act. And a lot of California and US businesses chose not to sort of interface vis-a-vis the internet in Europe because it was so hard to comply with this. Now that they've got to do it in California and Europe, some of these businesses might ultimately end up going into Europe because if they've got to comply with California, then they're probably going to be able to meet these standards. All right, so the CPRA business compliance requirements. As you can see, again, great for consumers, but really not so great when it comes to the businesses that have to implement this stuff. It's mandating that companies explicitly state their privacy notices and then make sure that they have clear criteria for really how the data is going to be stored and how long it's going to be stored. And then they've got to expand essentially their security, right? And they need to make sure that individuals have a private right of action for a data breach. Okay, that's not good from a business perspective. You have heard so many of these examples of data breaches, like Experian, Target, you know, a few names come to mind just in the last couple of years. They are going to be on the hook, not just universally in like a class action setting, but an individual whose data got breached, and meaning password and email and things like that, they're going to have a cause of action against these businesses. So, you know, I'm sure some insurance will come up for this issue, but this is definitely, we're going to have to step up our game in terms of what we're doing and what our business clients are doing. All right, added contractor category. Again, this is just expanding the definition of who's responsible. And it imposes really specific contracting requirements for businesses selling or sharing personal data with service providers. So it's sort of every level of data exchange that's on the hook. And then, of course, where I anticipate a major problem is how they're going to institute and distinguish between the under 16 group and the over 16 group. And as you can see, Californians were pretty in favor of this. So definitely taking their privacy rights seriously. Okay, so we've got a transition, or so I think we do. And we've got some changes likely to come from that transition. Real quickly before I move on, does anybody have any questions with respect to the data privacy and other particulars that I just covered since Prop 19 before moving on? Okay, if I don't see any popping up on the chat, but if you've got them, we can go ahead and attack those at the end. All right, so why I say change is likely to come is because, you know, unlike the California propositions, these are proposals, suggestions, talking points of somebody on the campaign trail. So we've got a lot of white papers and a lot of positions that have been explained during the course of debates. My general opinion is that we didn't hear a whole lot about tax reform during the general debates. We heard a lot about it in the primary on the Democratic side. But, you know, we've got COVID, we've got economic fallout from COVID, we've got some, you know, and we've got a very divided government, and we may not, depending on the Georgia runoff, even have much ability on the Democratic side to pass laws into effect. So I think we have a decent runway to do some good planning. My advice 3 months ago to clients was move everything now, because we have to expect January 20th, this law goes into effect, and it can be retroactive to January 1. So we were advising people move everything and anything they were comfortable moving, right? Really just sort of anticipating the worst case scenario from the estate tax planning perspective. But now it looks like, you know, we don't know what's going to happen. So here are some bullet points, essentially, of what's happening. What Secure Act, which was just instituted this last year, it's probably going to remain in effect. We still have the valuation discount, which is probably one of the only leftover favorable things we have. The income tax basis step up at the time of death may be eliminated. That in terms of long-term planning and effects on families, I think would be just huge. And commitment to keep income tax rates the same for families 400,000 or less. And then we do have a proposal to raise corporate tax rate from 21 to 28%. And then we really have an effort in the Biden campaign to capture all of the offshore earnings and impose a minimum tax of 15% on book income, sort of wherever it is in the world, making sure the US gets a share of that. And then raising the top individual income rate back to 39.6 from 37. And of course, for all of those passive income earners, increasing the investment income. So I'm going to focus on estate planning and estate tax changes, because that's obviously what we're focused on and what we're mostly giving advice on. But make no mistake, this step-up in basis, if it goes away or if it's on the chopping block, I mean, that is very much a part of the planning and the advice that we give, because as I mentioned to the person who asked the question earlier, we often strategize to make sure parents are holding certain properties at their death because of the step up, right? Because who wants to pay, a 30+% gain on $3 million? I mean, you can see it really, really, in addition to having an estate tax burden that has to be paid within a matter of months after death. If you need to sell assets to do that, now these assets have more than 30% taken out before it generates income to pay that estate tax. So you can see combined how drastic these changes can be. The current exemption is 11.58 per person, and this is what a lot of people I don't think really understood or appreciated, is that even if Biden or Trump or whoever doesn't take action, that it was already going to roll back to 5 million adjusted for inflation in 2025. So we've been talking to our clients for a couple of years now and really trying to say, look, we've got to do some planning, because even if no action is taken, we're going to have essentially a 50% reduction in the current estate tax cap. And then Biden's proposing that we increase the tax rate from 40 to 45%. And then here's the real big two, really, are lowering the exemption from the current 11.58 to 3.5. So for a married couple, that would be 7 million. And then lowering the exemption on gift tax per million. So going back to that question of, do you want to give now? Well, look, gift tax exemption is exactly matching the estate tax exemption right now. So you can give during your lifetime 11.58 million per person, right? 23 million per couple, depending on what you might have used in prior lifetime gifts. So yes, our advice has been give to the greatest extent possible. So what are the takeaways here, right? Everybody's heads are reeling. This has been literally a couple of weeks since we sort of know at least one piece of the puzzle. And we have at least an indicator of where Biden wants to go for the other piece of the puzzle. And so now we've got some sort of changed advice. And one is now really with the changes in the property tax reassessment and sort of eating away at the ability to pass on investment income properties to children without a reassessment, go ahead and without question put them into LLCs or other entities that can protect them from liability, protect you from that liability, and insulate your other assets outside of the LLC. Gift early and often, as I was just saying, and particularly if that $1 million cap comes into play on gift tax, then what you want to be looking at giving is things like startup businesses, right? Because those are going to have a price tag that is, zero or close to zero. So they might have future value, but you want to give them as quickly as possible before any of that value is recorded. Consider purchase transactions or partnerships with children in lieu of gifting, right? Because then we don't have a taxable exchange. You're sort of all there from the beginning. And there's a lot of creative ways to do that with loans and promissory notes. And as many of the advisors on the phone know, this is definitely something we can work with and probably the direction I see things going. And then, as I mentioned above, just anything you can give now, because if you have the ability to give away $11 million, right, and you're comfortable doing that, essentially when it goes down to $5 or to $3.5 million, the IRS has issued a ruling, and they made it very clear that they are not going to grab back at prior gifts during the prior years. So as long as that gift is completed in this tax year, even if Biden went to work right on January 20th and made it retroactive to January 1, your $11 million is not going to be taxed at that $3.5 million threshold. So you can see why we've been so busy in this industry this last year. And, you know, just for your planning, just make sure to calculate the cost of owning vacation homes and investment properties, accounting for the current assessed value. Parents or grandparents might be thinking, hey, this is going to give you $97,000 a year. No, it gave you $97,000 a year. It's going to give me $21,000. Is it really worth keeping? Right. And so we need to start to have that calculation in that discussion. Of course, business owners need to evaluate their privacy compliance and data collection, and then make sure that they're retaining expert advice. And that sort of dovetails into my final point, which is, you know, update your assumptions with your financial planners, your insurance agents, your attorneys, and to account for cash flow constraints caused by Prop 19, gift tax changes, estate tax changes, and so on. I think now more than ever, you're going to have to get really creative, like I said, with partnerships and other things that you know, you can avail yourself of in order to, you know, avoid this triple whammy. So really, my predictions is that we are probably going to have a massive sell-off of real estate, in particular in California. Even more so if that step up in basis goes away. I mean, I think that will have a real impact on real estate values across the board, maybe more so with commercial and income properties. I think we're going to have a lot of gifting in the next year or two if we get that extra year of opportunity, because Biden's going to be distracted with COVID. It's probably the only silver lining of COVID that I can think of. We're going to have lots of financial planning and probably a lot of purchasing of insurance products, and putting together irrevocable life insurance trusts, and maybe even establishment of endowments within trusts, so that if there is that sacred crown jewel property that you want generations in the future to keep, it has a nest egg to go with it to pay for those added costs if you're not lucky enough to have children that can afford that payment. And then last but not least, I'm predicting a massive exodus from California. You know, we already can't write off our state tax in the federal system any longer. Haven't heard anything about that changing, but those are sort of just my impressions of the overall impact of all of these things. So with that, I'll open it up to questions. And let's see, we have one. It looks like. Yes, so the question was sort of just the math behind Prop 19. And by the way, I do have that link, and the math is all right there within the text of the legislation. But essentially, yes, the question is, if the basis of the person who is dying with the property, let's say, or gifting the property during their lifetime, is $500,000, and the market value is 30 million. Actually, they go by current assessed value. They would go out and reassess it, but it's pretty close to market value. So essentially, the current assessed value when they come out and do their reassessment is 30 million. The new property tax base value upon which the tax will be calculated would be the 500,000 plus 1 million, and it does equal 1.5 million. You are correct in your math, so that's exactly right. And then he also asked about the 1%. So keep in mind, the 1% is going to apply to the remainder. So if you've got 1.5 where you're preserving mom and dad's property tax exemption, right, at 500,000, then you've got under that example a situation where you have 28.5 million that's going to go to the new tax base. Okay, so that essentially means you're going to pay 1% of that 27.5 or 28.5 million. So it's a big number, and it's definitely a different number than somebody who's paying 500,000. I've got a lot of clients, and this is going to apply to them, where they won't be able to afford their own home, and their kids will not be able to afford their homes if they have to pay that new fresh property tax value based on current valuation. Okay, another question is, oh, will the Zoom recording also be available to download? Yes, I think we can make that happen. It has been recorded and we're glad to get that out there. I don't know, via a link probably on our website or a Facebook page or something to that effect. I'll leave that to the experts. That's beyond my pay grade, but yes, we'll make sure it's available. Okay, any other questions? All right, great. Well, I'm glad I was respectful of everybody's time. I hope everybody has a great Thanksgiving next week. Stay healthy out there, and really thank you for joining us. We're here as a resource for you if you have any questions for yourselves or for your clients.